Oh, that's actually a great
example. Between
example.
Donda and CLB, you know what I'm saying?
I love it. We'll get right to it here in a second. We're going to give you a very quick guide to spread trading because when times get rough for volatility traders and price action traders, the spreads have to come in here. You have to make some creative trades out of markets that outrights aren't moving. The spreads continue to move. A to Z spread trading for beginners. I know you chopped it up with our friend Pete earlier in the week. We're going to take it a step further. And I want you to give maybe an analogy. It sounds like you already got a great one in mind here for what essentially a spread is, because this concept, I guarantee it's in all of your brains out there. It's simply like taking one thing and taking another similar thing. And then instead of saying like, oh, I'm going to buy both things or I'm going to short both of these things, I think the price should be higher. I think the price should be lower for an item like cereals or for, the wins of baseball teams in general. You can say, oh, well, I think their wins are going to be higher than their wins. And you can bet in sports, you can bet on the spreads between them, or in terms of trading, you can buy something and sell something and make money on the difference moving, not the outright markets. It's similar to essentially like speculating on album sales, right? You don't think album sales are going to go higher or lower. You're spreading Drake and Kanye against each other.
Yeah, most definitely. And at the essence here, I mean, one of the best ways you would really try to employ a spread trade is, if something's really underperforming, then you'd look to buy that thing. And if something's outperforming or overperforming relative, across time period, you would sell that other thing. And like you have here, the trade becomes one at that point. And that's the key part. The trade is you're trading it together. You're not trading them separately. You're not looking for a situation where, the buy side works and the sell side doesn't, and you decide to take the buy side off and keep the sell side. You got to keep it as one trade. I mean, that's the way you're doing it as a spread. Overall. So in that case, we're talking about the album. Say you decided to buy, I mean, it's not conceptually easy, but let's just, indulge for a moment. The idea that you're buying, Kanye albums and selling Drake. I don't think Drake album is going to be good. I'm selling Drake's album. I mean, these basically came out around the same time. You're saying I'm selling Drake's album and or sales, I guess is a good way, like you said. I'm selling sales. I don't think Drake's going to reach the sales as Kanye. I'm buying Kanye sales. I think those are going to be trading more. And you look a month from now and see who ended up selling more. So that's one way to do the spread. And you wouldn't get it. You wouldn't take it off halfway through. I mean, 2 weeks from now, you hold that spread to completion, because that's how you get blown out when you don't keep the spread on.
That's exactly right. And here, I'll take it even one step further here. It's essentially saying, I don't know where streams of hip hop music is going in the next month, but I do think that Kanye is going to get more streams, more songs streamed than Drake is. And so I buy Kanye versus Drake. And now I don't care where that number of streams is going. I don't know where streaming services, if streaming is going to do good or poorly in the next month, but I have the spread on that all I need to happen to win is Kanye to outperform Drake. And it works in so many other things as well. Mm-hmm. And we're going to talk about it at interest rates, but I think you guys talked about it in equity indices. And it's the simple notion of like, I don't know if stocks are going up or down, but if I buy energy and sell tech, stocks can crash, stocks can rally 10%. As long as energy outperforms tech, I'm in the green, and that's all I care about. We're talking about it with interest rates here today, and hopefully this is an illuminating graphic, because what you have in white is the S10Y, that's the 10-year yield. In gray is the S30Y, that's the 30-year yield. And you can see that these two similar components, they fluctuate hand in hand, but as they move higher, as they move lower, or as they move sideways, the difference between them is going to also fluctuate. And that is the spread that you see in red. Is this all making sense to you?
Most definitely. And at the end of the day, is it fair to say the same things move the 30-year and the 10-year? They move for different reasons, but it's fair to say the same thing moves them. And that's the best way to look at this. I mean, because you want to employ a spread really with a situation where you have two things that move for mostly the same reason. And I like it how you have the difference between them here, because at the end of the day, that's what we're really looking at, the difference between the two, how much that's fluctuating over time periods. And so then you can look to see when is one more rich than the other one, at what time period. you look at times and say, hey, maybe this is a good time to put on the spread. This is across the past year. So, you get an idea of where we were earlier in March when this was much higher, meaning 30-year was trading over by, XYZ amount.
Sure.
And then you see where we are now. So maybe, given this past year, maybe it's a good time to look at it.
Well, and just what you look at this chart and you look at the first half of it, and you have the spread in red moving sideways. Not a lot of movement there, and thus maybe you're not trading the spread. During that time, yields in general are moving higher. And so you have right there, it's like, oh, this thing moves different. Like it moves different than the outrights. It's not necessarily outrights up, spread up, outrights down, spread down. And then you have something interesting, like the spread hits a high in March, but then the yields continue to move to their highs for the year as the spread between 30 years and 10 years drop down lower. And so you've got this thing that acts differently, and now yields being stuck in kind of like a holding pattern, moving sideways for the last couple of months in that gray and white line there. You've got the red line in the spread actually moving down to new lows. And so now let's look at when hopefully people understand what a spread is, given all of our analogies and everything else, and that portrayal of the two markets that you're spreading against the spread itself, which becomes just one thing. Now looking at that one thing, you have the 30-year minus the 10-year, the knob spread. I'm sure you've heard of in the past, Jermal, given your professional trader status.
Actually, it's funny because I hadn't really heard of it, but then Pete mentioned it one day, and I was like, oh, I don't remember that term, but I'm glad you guys are bringing it to my attention again.
It's one of those things that, like, I think a lot of people like to toss around, like, oh yeah, the knob spread, like, oh yeah, I'm trading knobs and interest rates, without necessarily understanding it completely. But it is like a ubiquitous term, at least amongst like futures and interest rate traders. So no shade that you don't know it. It is a big time spread, probably one of the most popular spreads in trading in general, definitely in interest rates. But what you have here is a relationship, right? Like it's the difference between 30-year interest rates and 10-year interest rates. Pretty easy to grasp. Now, how do you trade it? With spreads, averages and means are really, really essential, way more essential than just prices on their own. As you see, S&Ps and NASDAQ, like those can just go higher and higher and higher with no regard to a mean. But the relationships between tech stocks and energy stocks tend to like kind of go back and forth between each other. Same with interest rates. And so when you see a relationship like this dive way lower than it's usually at, way below the mean, it creates for a pretty simple and common strategy, which is simple reversion, something that you understand from volatility.
No question. And for me, when I look at this, what I'm really drawn to for whatever different reason are the two big drops I see. The one at the end of February, beginning of March. That might be, I don't remember what that was, but maybe you remember, maybe that was a Fed meeting. I know the one in June for sure was, because that June one stands out on not just, this rates chart, but a lot of different charts. So those are what I'm drawn to right away. But looking at this, you start to wonder like, okay, maybe this is a good time to put this on because of where we're at. Now, just for clarification's sake, when this spread is higher, 30-year trading over 10-year, what does that signify for, the economy overall and vice versa when the spread is lower? What do these signify?
Sure. Great thing to bring up. And I think a great place to essentially close here is like when it's low and I want to buy it, what am I doing and what does it mean? And when it's high and I want to sell it, what am I doing and what does it mean? So when it's low, right, like it is right now, and this is particular to interest rates, that means that the curve is flat. Okay, if the spreads are low, that means the yield curve from 2s to 5s to 10s to 30s is flat. And it makes sense because that just means the difference between rates is relatively little. It's a flat curve as opposed to being, an upward sloping curve. And that would signify steepness. So that's like kind of the same way that bearishness reflects the opposite of bullishness, flatness reflects the opposite of steepness. And so if I think this spread is going to go higher, I would buy it and put on a steepener or like a bullish trade in an outright. In the same way, flattening, selling the spread, thinking that it's going to go lower. And that being said, it just signifies, flatness usually signifies like potential turmoil, like Essentially the market is telling you we're unsure of the future. Like, we don't know if rates in 10 and 30 years are going to be a lot higher, or if rates are going to be, closer to zero, because there might be some kind of economic drawdown. Now, when this spread is high and the curve is steep and the difference between yields is large, that usually signifies like everything's pretty hunky-dory. We're pretty confident in where we're at, and we're pretty confident that stuff is going to stay normal for the next 5, 10, 30 years here. And so this is why this is such an intriguing trade for two reasons. Like the reversion reason, we're at the lows in the knob. I like buying this knob spread, the long 30 or short 10-year there for that reason, as well as we've got a stock market telling you everything's chill, man. Like, we're doing real well. We've got all these we got non-farm again tomorrow. We got non-farms coming out the wazoo that are telling us that stuff's pretty chill. Like, we're doing pretty well. But these interest rates right now are reflecting the opposite, which is saying like, we're kind of unsure. Now, time will tell if stocks come down to meet what this is telling us, or if this comes up to meet what stocks are telling us. So that's what I would say. Does that make sense?
Absolutely makes sense. That's why I wanted to clarify, because, that's exactly what it's showing, it seems like to me. And that's why this is interesting. I always like to understand not only, the numerical part of a trade and the idea of a spread and what it's doing currently, but what it potentially signifying it means, especially when it comes to bonds. Because one thing I learned a long time ago is that bonds tell you the real truth of what's going on overall in the market versus stocks. Like you said, we got the stock market that's shooting up. We're making new highs every day. I think we made our 53rd high overall. That's the most highs through August like ever. Even going back to when you look at 2017, we made all these new highs like crazy every day. Well, I think we'd only made 33 up until this point in 2017. We've made 53 at this point, right? So it's interesting because we're continuing to go up. But like you said, more recently, we've started to see some macro stuff that show us that people are a little worried, and we've seen, pick up in Delta variants. Now, is that going to turn a corner? Possibly. Maybe that's one of the reasons why you're interested in buying this spread, because this, like you said, is showing there's some fearfulness about what's going on right now in our economy. And the economy and stock market, they're not married. They're not mutual. I don't even know if they're dating, but that's the way that it's been for the past year at times. And so basically what we see is that there was real optimism in the early point of the year, and now is a little pessimism. So yeah, absolutely makes sense.
Awesome, man. I think that's a great place to finish here today on Spread Trading for Beginners. Hopefully everybody out there enjoyed it, got the concept of spreads, and maybe even a pretty intriguing trade here with that knob spread down at the lows. Definitely an interesting one for me, and it sounds like Jermal as well, man. Anything else you want to say going into what is a long weekend and most likely to be filled with Certified Lover Boy by Drake?
Yeah, no doubt. I mean, it sounds like it could be an interesting album. I know it's going to be played a lot in my house. My oldest son loves Drake, so I'll be hearing plenty of the cuts. We'll see what they do. And at the end of the day, if you don't want to share a stick with me anymore, that's fine. You know what I mean? Like, I keep my own stick. I got a good stick, just so you know. And it,
all right.
Well, on the pool, I'm just saying. I just want you to understand. I have a good stick, pool stick. God,
yeah,
just in the gutter. I
mean, unbelievable. Okay, truly a family show. You remember that, all right? All right, Jermal. Thanks so much. We'll chop it up next week on spreads and everything else, and the ever-growing debate between Drake and Kanye. We'll see what Jermal's children have to say about that. I'm genuinely interested to see what they have to say about it. We'll meet next Thursday, but we need to get out of here because Splash in the Futures is coming up next. That means Peep Moment. That means more of yours truly. And that means a bunch of trades in the Tastyworks platform. Hang out for that, everybody. Thanks for watching.